insurance industry tracks catastrophe to monitor claims cost, assigning a number to each catastrophe. Each claim arising from the event is tagged so that total industry-wide losses can be tabulated. The term catastrophe is often used in the property insurance industry in a narrow way to mean a catastrophic event that exceeds a dollar threshold in claims payout. This figure has changed over the years with inflation and the increase in development of areas subject to natural disaster. Starting in 1997, the catastrophe definition was raised from $5 million to $25 million in insured damage. There have been four catastrophes that fall into the mega catastrophe categories greatly exchange the 25 million threshold. The first two, Hurricane Andrew 1992 and the Northridge earthquake 1994, were both watched events in that they were far more destructive than most experts had predicted. A disaster of this type would be third, the terrorist attack on the World Trade Center in 2001 altered insured attitudes about man-made risks worldwide. Hurricane Katrina 2005, the further catastrophe, is not only the most extensive natural disaster on record but also an event that intensified discussion nationwide about the way disasters, natural and man-made, are managed. It also focused attention on the federal flood insurance program. See the topic on flood insurance. Cell phones and driving. Increased reliance and cell phones has led to a rise in the number of people who use the devices while driving. There are two dangers associated with driving and cell phone use, including text messaging. First, drivers must take their eyes off the road while dialing. Second, people can become absorbed in their conversation that their ability to concentrate on the act of driving is severely impaired, jeopardizing the safety of vehicle occupants and pedestrians. Since the first law was passed in New York in 2001, banning handheld cell phone use while driving, there has been debate as to the exact nature and degree of hazard. The latest research shows that while using a cell phone when driving may not be the most dangerous distraction because it is so prevalent, it is by far the most common distraction in crash and near crashes. Research studies about cell phone using while driving have focused on several different aspects of the problem. Some have looked at its prevalence as the leading cause of driver distraction. Others have looked at the different risks associated with handheld and hands-free devices. Still, others have focused on the injuries in crashes involving cell phone users and the demographics of drivers who use cell phones. Of increasing concern is the practice of texting. In January 2010, the National Safety Council released a report that estimates that at least 1.6 million crashes, 28% of all crashes, are caused 200 crashes. The estimate is based on data of drivers' cell phone use from the National Highway Traffic Safety Administration and from peer-reviewed research that quantify the risk using cell phones and texting while driving. In July 2009, Tech Transportation Institute released a study showing that the risk of texting while driving is far greater than previous estimates showed and far exceed the hazards associated with other driving distractions. Researchers used cameras in the cabs of trucks traveling long distance over a period of 18 months and found that the collision risk became 23 times higher when the drivers were texting. The research also measured the time drivers stopped looking at the road and used their eyes to send or receive text. Drivers generally spent nearly 5 seconds looking at their devices before a crash or near crash, a period long enough for a vehicle to travel more than 100 yards at typically highway speeds. Credit scoring: the goal of every insurance company is to correlate rates of insurance policies as closely as possible with the actual cost of claims. Insurance set rates too high, they will lose market share to competitors who have more accurately matched rates to expected cost. If they set rates too low, they will lose money. This continuous search for accuracy is good for consumers as well as insurance companies. The majority of consumers benefit because they are not subsiding people who are worth insurance risk. People who are more likely to file claims than they are. The, the computerization of data has brought more accuracy, speed, and efficiency to businesses of all kinds in the insurance arena. Credit information has been used for decades to help underwriters decide whether to accept or reject application for insurance. New advanced information technology have led to the development of insurance scores which enable insurance to better assess the risk of future claims. An insurance score is an numerical ranking based on a person's credit history. Actual studies show that how a person manages his or her financial affairs, which is what an insurance score indicates, is a good predictor of insurance claims. Insurance scores are used to help insurers differentiate between lower and higher insurance risk and thus charge a premium equal to the risk they are assuming. Statistically, people who have a poor insurance score are more likely to file a claim. Insurance scores do not include data or on race or income because insurers do not collect this information from applicants for insurance. The poor economy has not had a negative impact on credit scores. According to an April 2009 Property Casualty Insurance of America release, the recent economic downturn did not have the negative effect on credit scores that some people predicted. Major consumer credit reporting agencies such as Fair and TransUnion have reported that average scores remained steady or have improved possibility because consumers are saving more and paying off debt. Despite the economy and credit crisis, no state has made regulatory changes to insurance use of insurance scores PCI notes. Federal activities: the Federal Trade Commission has asked nine of the largest homeowner insurance companies to provide information that it says will allow it to determine how consumer credit data are used by the companies in underwriting and rate setting. The Fair and Accurate Credit Transactions Act passed in 2003 directed the FTC to consult with the Office of Fair Housing and Equal Opportunity on how the use of credit information may affect the availability and affordability of property insurance, whether the use of factors by credit scoring systems could have a disparate impact on minorities, and if so, whether the computer models used could be modified or to produce comparable results with less negative impact. The study is expected to be finalized sometime 2010.